Howdy, good morning. Impromptu beverages with Bree. Today's beverage is coffee, which I've only had 1 cup of. So if I trip over any of my words, bear with me. Sorry, guys. I wanted to get this out to you as soon as possible. So what I want to talk about today is the Iran conflict. And here's how the escalating Iran conflict is impacting the markets. And more importantly, what it means for your portfolios. Oil prices have moved sharply higher following this weekend's escalation, as we're calling it. Markets are pricing in a supply risk tied to instability in the Persian Gulf, particularly around the Strait of Hormuz, which is a critical shipping route for global energy flows. Try saying that 5 times fast. So the Strait of Hormuz. And why this is important, higher oil prices matter because energy feeds directly into transportation costs, inflationary costs, corporate margins, and your consumer spending power. Because if you're paying more at the pump, you have less money to spend elsewhere on Amazon. So if energy remains elevated, it complicates the inflation outlook and potentially delays Fed rate cuts. Right now, we're seeing equity markets are rotating. Energy and defense so far this morning are outperforming. Fuel-sensitive sectors that depend on fuel pricing like airlines, transportation, consumer discretionary companies, those are all seeing more pressure today than normal. This is typical geopolitical behavior. This happens every time something happens to upset oil prices. So the broad indices, the S&P 500, the Dow Jones, the NASDAQ, they're volatile right now. They're not broken. And the biggest question on everybody's mind is duration. How long is this going to last? Short conflicts create temporary repricing, and then we can all go back to normal. Extended supply disruption creates structural repricing. Right now, the markets are reacting to what's going on. They're not panicking at all. And the real market risk is not this headline. It's not the news conference we all looked at this morning. It's the second order effects. And what do I mean by the second order effects? If oil stays elevated, inflation could reaccelerate. The Fed may remain restrictive longer, meaning no rate cuts anytime soon. And then those rate expectations get way pushed out. So here's the critical part. Our portfolio discipline is built for moments like this. Your portfolio is built for moments like this. When markets surge in one sector, like energy right now, those positions grow beyond their targeted weights. While other areas pull back, like consumer discretionary, those weights shrink. Our rebalancing that we do every quarter systematically trims exposure to sectors that have run up. So if they've been super positive, we sell some of that back. And then we add to the areas that may have pulled back, maybe have not done well. That allows us to maintain target risk levels and prevents emotional overreaction in portfolios. Bottom line, we're not chasing spikes. We're not selling into this fear. We're restoring intended allocations. Rebalancing forces us to sell high and buy low. And it keeps us aligned with our long-term strategy. The best part about it, it removes guesswork and emotion from the portfolios. So we're handling risk management structurally for the portfolios. Right now, the Iran conflict is creating higher oil prices, short-term equity volatility, and a little bit of sector rotation. The durability of this move depends entirely on escalation and duration, meaning how bad is this going to get and how long is this going to go. But our portfolios are built with an allocation discipline and systematic rebalancing, and so they're designed to absorb this kind of shock. We need to stay diversified, rebalance intentionally, and let volatility work for us, not against us. So we are continually monitoring escalation risks, the energy market, and inflation. For now, all you have to do is go out and lead an abundant life. I will talk with you soon. Bye, y'all.